Did you know the US Federal Reserve just paused interest rate cuts, despite consumers begging for relief and markets praying for cheap credit? Today, we unpack why this wait-and-see stance isn't just cautious. It could upend the entire global financial order. The scene, June 18, 2025. The Fed holds steady at 4.25 to 4.50% for the fourth consecutive meeting. No hike. No cut. Instead, policymakers issue warnings, inflation remains sticky, tariffs loom, and global volatility is flashing red. On the surface, it looks like maintaining status quo. But behind the scenes, the Fed is walking a political tightrope. President Trump blasted the Fed chair, calling rates artificially high, pushing for drastic cuts now, and even floated naming a new chair before Powell's term ends in May 2026. Wall Street flinched. Here's why that matters. The Fed is caught between market complacency and macro risk. On one hand, markets are already pricing in 2 rate cuts by year-end, with traders speculating July could bring the first one. Money is flowing into growth assets, tech, Bitcoin, corporate junk bonds, all chasing future liquidity. This has created an almost free money illusion. But here's the trap: the Fed doesn't just adjust rates for investor sentiment. It's fighting real inflation, fueled by tariffs and weakening supply chains. New U.S. tariffs hitting after July 9 threaten to ripple through producer and consumer prices, potentially reigniting inflation. Meanwhile, labor data is wobbling, jobs slowing, unemployment nudging up to around 4.3%, signaling that the labor market is cooling but not collapsing. Fed officials are divided. Some argue for a July cut, pointing to cooling inflation and a precarious labor market. But Powell and the majority refuse to budge, stating they need higher clarity on tariff fallout and inflation data. The consequences? If the Fed capitulates to pressure and cuts prematurely, it risks fueling asset bubbles and imported inflation. But if it holds too long, it could crash the housing market, tank the jobs market, and fracture a global economy already on edge. Remember the crash in April 2025? A massive tariff shock sent global markets sharply lower. This Fed move could pull more triggers. So why not cut now? Because it's a global system quake waiting to happen. Emerging markets, corporate debt, and US Treasuries are sensitive. A sudden rate pivot could unleash inflation imported into fragile economies, destabilize exchange rates, pop debt bubbles, and trigger a cascade of defaults. Equally, sticking with high rates too long could crash US consumer spending, amplify global recessionary pressures, and break the illusion of a soft landing. Markets are already showing signs of tension. Popular pain trades include long gold and tech positions bet on rate cuts, and short dollars. If the Fed goes hawkish, these could collapse across records. So where do we go from here? Watch July 29th to 30th, the Fed's next meeting. Ahead of it, 2 things will shape the outcome: a surprise tariff spike after July 9th and the core PCE inflation trend. If inflation stays above 2.8% and tariffs bite, expect a hawkish hold. If inflation softens and tariffs stall, Powell may shift. That day could be the tipping point. A cut in July might stabilize markets short term, but it risks igniting inflation and undermining the Fed's credibility. A hold or slight hawkish pivot might spook markets but could protect global stability in the long run. And the global ripple effect? Former global central bankers warn that politically driven micromanagement of central banks hurts systemic trust. That means a Fed that backs down too easily could weaponize politics over monetary policy. In short, the Fed's next move isn't just US monetary minutia. It's a global balancing act between inflation, politics, and market psychology. If they misstep, the consequences could be seismic, derailing emerging markets, triggering global bond sell-offs, and undermining the entire financial architecture. Bitcoin watchers, take note, this is where digital scarcity could shine. In a world of money printing and policy uncertainty, Bitcoin emerges as a hedge against fiat fragmentation. So here's the bottom line: when the Fed meets in late July, expect fireworks. Markets will be forced to choose faith in Washington or fear of fiat failure. Stay sharp. The Fed's chessboard move next month could reset the global system. Will they checkmate inflation, or be checkmated by markets? Don't forget to like, subscribe, and share if you want timely, macro-charged Bitcoin breakdowns. See you next time.